Hey everyone, this is Chris. Welcome back to my YouTube channel. In this video, we're doing part 2 of a 3-part series that's walking through the mortgage loan process piece by piece. Again, whether you're a first-time home buyer or somebody that's buying your 5th house, these videos are going to be helpful for you because no matter if you've never bought one or you have, oftentimes people forget and it gets confusing, and mortgage world changes from year to year, it feels like. So these videos are going to be super helpful if you just need a refresher on what the mortgage process looks like. Video 1, we started at the very beginning, even applying, and then applying and then walking through things with the lender and then getting your pre-qualification letter. Today we're going to walk through the process of you've got a house, you've got a contract, what happens next? So you've taken the pre-qualification letter, you've gone to a few houses, and you finally decided which one that you want. The real estate agent is probably writing up a contract for you. Meanwhile, the lender is waiting patiently and excited, waiting to see what it looks like, what the house looks like, what the price is, to figure out where in our plan together you guys landed. And so it's always exciting for the mortgage lender to finally figure out what the house is going to look like and what the plan's going to be. And so once the contract is signed by both the buyer and the seller, you want to give that contract over to the lender, because that is going to tell the lender exactly all of the dollar amounts that were agreed upon in the contract. The lender's going to want to know all of the things on the contract that deal with the finances. And so what the purchase price is, are you splitting any title work, or is there contingencies around an inspection? All of those things the lender is going to want to know, because the bank wants to make sure the contract is executed on your behalf, so that when you walk into your house in the end, all the things that you agreed upon at the beginning have been done. And so the contract really gets everything started. The lender at that point is going to get your loan details updated, and because they're going to want to follow that contract to the T. And so once they get all of that done, everything starts to feel organized. They're going to take all the documents that you've already given them at the application stage, get all of those prepped and ready to go. And then at that point, the lender is going to be ordering an appraisal for you. The reason why the lenders have to order that is because there are strict guidelines around how appraisers are communicated with, because back in the day, there was a lot of bad practices between people who were invested in the process and the appraisers. And obviously the government has decided that it's best for the appraiser to be an objective third party that gets brought in to help figure out what is the actual value of the house. And so even though the bank is deciding the appraiser, there is a process behind the scenes that is regulated by the government to make sure that that is happening appropriately. And so the bank is going to order an appraiser. The bank is also probably going to reach out and get some title work started, depending on the state that you're in. Maybe you're in a state that where you have an attorney's office write that up, but the lender is probably going to be reaching out to make sure that title work and title insurance are all getting lined up. Really, there's a lot of things happening behind the scenes from then on, which I'll get into in a second. But at this point, you've kind of done all of your hard work. You've gotten all your documents in, you've been out looking. Really, at this point, if you haven't chosen a home insurance agent, that's probably what you want to do next. But other than that, a lender really should be taking care of a lot of different things for you in the background, and ultimately just letting you know what's happening when it's happening, and they will reach out to you if they need anything. And hopefully if they'll reach out to you also when they don't even need anything too. So it'll really be up to you to figure out who your home insurance person is. But other than that, it's your time to kind of just start getting your house prepped, or if you're moving from an apartment or whatever, you're getting your things packed up and ready to go. On the lender side of things, they are going to move everything over to what's called processing, generally speaking. So the process is when you have a person that's working on the loan file, and their job is just to get things organized, looking up addresses, making sure all of the details are done in accordance with what the government wants the loan to look like in terms of regulations. And so there's a processor that's going to be involved. Sometimes they'll reach out to you, sometimes they maybe don't need much from you, and so you may or may not hear from them. But at the end of the day, the loan officer is the person that you've probably reached out to, and so they'll be communicating with you. Now, a couple things can happen at this stage. Number one, your lender is probably going to work with you on figuring out what your rate is going to be, because at this point, you're probably ready to be locking in a rate, or at least talking about that. Now, there are some programs that lenders can do where you have locked ahead of time because maybe you're in a market where you're really scared that the rates are going to go up. And that's fine. Those are kind of one-off scenarios that the lender is choosing to do. But typically speaking, at this point in time, when you get a contract, you're probably going to be having a conversation about locking in a rate. And when you do that, probably part of that conversation is, if you want to do a buy down, if you want to just spend no money, extra money on a rate, you can check out one of my other videos on how to choose a rate to understand the extra closing costs that could be involved with choosing a rate, but ultimately it's your decision. The other piece of the puzzle is too that the lender needs to look at is from this day until closing day, they need to make sure that the rate lock is set for that whole time period, because in the backside, the lender is probably using an investor behind the scenes to guarantee this rate, and the investor, depending on how long they need to guarantee this rate, the pricing of that rate can go up and down. So if you have a very short window, you're probably going to get the best pricing on your rates. So if you're at a 30-day lock window, then you're probably just going to get the optimal, because the investor doesn't have to guarantee that rate for very long. But sometimes you might need 60, or sometimes you might need 90 days because just what was agreed upon with the buyer and the seller. So in that case, you may get a little bit of a change in the rate, because again, the rate sheet is based on future expectations. So behind the scenes, an investor is saying, okay, if you need that rate and you need it held for 90 days, that's actually a little bit more of a risky scenario for the investor of this loan. And so they're needing to guarantee that same rate for you, but for a longer period of time. And so just understanding a lock window matters. And so usually in 15-day increments. So just understand that is part of that process. Also, what happens when I mentioned that an appraisal gets ordered, the appraiser comes in as a third-party opinion, and their job really ultimately is going to be very similar to what the real estate agents are doing. And ultimately, if they're doing the same work, hopefully they're landing probably mostly on the same dollar amount. But what can happen is that sometimes the appraiser decides the value could be higher, or sometimes it could be lower. If the value comes in higher, that's a great thing. It doesn't necessarily change any of the values of the loan, because the loan, the value of the home is going to be either the appraised value or the purchase price, whichever one's lower. In mortgage world, it's always based on risk and worst case scenario. So if you get a higher appraisal, it's just good to know, because you're starting your home off with extra equity. When you refinance down the road, that will make a difference, because your home had that extra value in it, so that will be realized at that point. But it's kind of just a nice to know at the beginning. If the home is valued a little less, that gets into a little bit more of a tricky situation. And so roughly speaking, like I just said, it's either the purchase price or the appraised value, whichever one is lower. If the appraised value comes in lower, that's where the whole loan is based around. So usually there's a gap. If you ever hear the word of an appraisal gap, because the purchase price is still here, that hasn't changed. You agreed on that with the seller, but now the value of the home is a little bit less. And so there's a gap there. And so ultimately, it's going to fall on somebody to cover that gap. Sometimes the person who's buying the home just needs to cover that bit of gap. Sometimes you can renegotiate depending on the market, but that would be a conversation that would need to be had at the time that the appraisal comes back. It's uncommon usually, so you don't really have to worry about it, but it does happen sometimes. So the loan is in processing. The processor gets everything packaged up, and then the job of the processor is to get everything nice and organized and then send everything to the next person in line, which is the underwriter. Every lender is going to have an underwriter. The underwriter's job is just to make sure that they understand the guidelines front and back, because they want to make sure that this loan satisfies all of the details around the regulations. And so that's why you may come back, and almost always there's going to be extra conditions. So typically once the underwriter has looked at it and they say, yes, this loan is going to be good and approved with these few conditions. And so that next step is going to be called generally conditionally approved, meaning that as long as we can get these few extra things cleared, this loan's going to be okay. So that's always a good marker point once you get your first set of conditions, because also ultimately it just means that you just need to satisfy these extra things and we should be good to go. And so sometimes it has to deal with the statements that you sent in, the documentation. Maybe there's just some follow-up questions on some of the things, because again, everybody's scenario is different. So having conditions at this point is very normal, because everybody's different. So your job would just be to get those things in, and then again, get them packaged up and sent back to the underwriter. They would look them over and say, yep, cleared, 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 cleared. And at that point, once the underwriter has looked over all of those items, has looked over the appraisal, make sure that's good, then at that point, once you hear that the loan is cleared to close, that is a huge celebration, and ultimately that is where we are going to stop today. So we took this video from contract all the way to cleared to close, and so that's a big process, but the final video is going to be what happens after cleared to close and closing and all of the details around that. Once again, thank you so much for stopping by my YouTube channel today and watching this video today. Please like and subscribe, interact. Would love to chat with you. Have a great day.